Here. So I'm on my lunch break from work, so I only have about 30 minutes, but we're going to try and blast out some information here. I just kind of want to reiterate some of the stuff that I have gone over recently, or at least on this channel over the past few years even, talking about what the Federal Reserve is attempting to do with their interest rates. A lot of times I will see people talking about how they will not keep interest rates elevated because the government can't afford it, or the markets will crash, or the housing market will tank, or something like that. And they look at some of these other items or other parts of the economy and say, like, this is the reason why the Federal Reserve will or won't move. But really what it comes down to is inflation expectations. And that's really what the Federal Reserve is trying to actually maintain, to keep a inflation expectation that is well anchored, because that was the original problem that the Federal Reserve had experienced for the past 10 years prior to the pandemic kicking in. So now I have put some links down in the description. One of them is to this speech that I constantly go back to, and it's Monetary Policy Strategies for a Low Neutral Interest Rate World. And this was given by John C. Williams back in November of 2018. And one of the things that he says in here, I think, is really just very telling about what it is that the Federal Reserve is looking to do. Because this is what it says here. Today, we face an altogether different set of problems stemming from a very low neutral interest rate. That is the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. So now, this is something that I found very, very difficult to try and wrap my head around, because it's so confusing what it is that he was saying there. Today, we face an altogether different set of problems stemming from a very low neutral interest rate. The neutral interest rate is when the Fed funds rate is neither accommodating nor restricting the economy. And that low neutral interest rate was somewhere, well, there is an exact number, but a lot of economists said it was somewhere around 2 to 2.5%. John Williams in this speech believed that it was somewhere between 0 and 1.5%. So the neutral interest rate was really low to zero. That means stimulating the economy becomes very difficult for the Federal Reserve, because they run into what they refer to as the lower bound, which is zero, meaning that dropping the interest rates or the Fed funds rate well below the neutral interest rate in order to stimulate the economy becomes incredibly difficult. And the reason why there is a low neutral interest rate is because inflation expectation at the time was running very low. Remember, this is 2018. It says in this speech here, monetary policy, he says here in the speech, monetary policy is always swimming upstream, fighting a current of too low inflation expectation that interferes with achieving the target inflation rate. So this is the problem that the Federal Reserve had, is that inflation expectation was running persistently too low prior to the pandemic. And if you remember right, it was towards the end of the Trump administration that he was wanting to fire Jerome Powell, because he was keeping interest rates elevated, and that there was no inflation, and that there was no reason for it, and that the Fed should take interest rates into negative territory and be printing money, right? He was trying to lower the inflation expectation at the time because it would raise the real interest rates. Now, this is something that is very difficult to try and wrap your head around, why it is that they would be working in cahoots, but yet have to find this act of yelling at each other or making this enemy kind of thing happening, but it was in order to achieve the inflation expectation goals that they were looking for at the time. So now, when we think about inflation expectation running low and in messing with the Federal Reserve's monetary policy, right? How is it that they are, in order for them to stimulate the economy, when the interest rates or the neutral interest rate is so low? They've run out of monetary policy. Right? That means dropping interest rates is no longer an effective tool. They had to figure out a way to stimulate the economy. We're in the middle of a pandemic. You drop the interest rates to zero. It's not enough beyond the neutral interest rate to really stimulate the economy. And here you are with this pandemic going on. What happens, right? Money printing goes off, and the stimulus comes in direct stimulus packages. It's not like prior to, like during the great financial crisis, for example, when they dropped interest rates as low as they did. That was well below the neutral interest rate, or enough below the neutral interest rate to at least give the impression to people that they should go out there and borrow money to buy houses and cars and go on vacation and buy bonds and stocks and all the other stuff that goes along with it. And that's exactly what they did for the 10 years that they were doing it. But it wasn't like in such a fashion that it caused an inflationary scenario, because all money has to enter all channels at the same time in order to drive the inflation scenario. Quantitative easing 1, 2, 3, and 4, it only entered in particular channels, right? The housing market, the bond market, stock market, stuff like that. So this time around, when the stimulus went out there and everybody got, well, not everybody, because I know a lot of people say they didn't get any stimulus. So when stimulus packages went out there and it went out in a broad spectrum of the economy, all of a sudden money's entering in at all channels, and you see the inflation start to happen. The supply chain being broken down just reaffirms, right, that this inflation scenario is going to be persistent. And once people believe it, it is now stuck in that inflation scenario, because inflation expectation is a self-fulfilling prophecy. People begin to behave in ways that then causes the inflation. They will pay more for an item just to get it because they believe that there's shortages, or they will buy extra because they believe that they won't get it, or that they believe that the price is going to move up, so they'll buy it today thinking that tomorrow it's going to be more expensive. And that self-fulfilling prophecy is really what the Federal Reserve was looking for. And even in their speeches today, when they talk about defending the inflation defending the inflation expectation, right? And that's really what they say out there. And you think about it, it's not like they're trying to, like, you think about it, defending something means you're trying to protect it, right? That's what defending means. So when they say defending the inflation expectation, they like the inflation expectation being elevated. That's exactly what they were looking for. The farther the inflation expectation stays elevated, then the more the neutral interest rate begins to rise. Okay? And although we've seen it like rise and then fall just recently, I believe that if the inflation expectation is still to remain elevated going into the future, and we find reasons for a broken supply chain, maybe like possible lockdowns or something like that, I'm not trying to predict the future, I'm just saying if that was to occur, then we may find the inflation expectation start to run rampant again and then start to raise that neutral interest rate again. So ultimately, that's really where the Federal Reserve is looking at, not at the markets, not at like, housing market or stock market. That's what a lot of people want to look at. A lot of people want to look at politics and say, well, it's election year and they're not going to prevent, whatever, I mean, they make up a bunch of stories about that. But, you think about it from that neutral interest rate and how far below or above the neutral interest rate that the Federal Reserve has positioned themselves in order to restrict or accommodate the economy. When it comes into stimulating the economy, how do they plan on doing it again? I mean, if they don't get that neutral interest rate elevated significantly, like how far below the neutral interest rate can they possibly go in order to stimulate the economy, right? Not from the natural like occurrence of people going, wow, those are really good interest rates, I'm going to take out loans to buy houses, cars, and go on vacation, right? This is really where, again, like if they don't raise the neutral interest rate quite significantly, or get the neutral interest rate to be elevated quite significantly, then it's going to take ever increasing amounts of government stimulus packages to go out there in order to take on the debt and inject that money into the system, because people won't naturally be doing it with the purchases of homes and cars and going on vacation, or at least to the extent enough in order to get the economy stimulated. Wow, man, I am really diving deep into this one. I hope I'm not just completely confusing the hell out of everybody. But again, leaving that speech down in the description, I think is probably really telling. Like if you read through the speech and kind of break it all down, some of the things that he is saying, you're going to find that there was a lot of things that were occurring back in 2018 that needed to be solved. One of them was like the demographics issue, right? There was a slowdown in global growth, right, that was taking place. There was the low neutral interest rate. You think about all the talks of what happened with the COVID sickness and all the people dying and how many deaths there were, right? Did that really take a chunk out of the demographics issues that the Federal Reserve was talking about? Global growth. What happened, man? We had this huge depletion of manufacturing that has taken place, especially right now. When this is all done, right? When you hit the valley, and you start to reestablish manufacturing in the most efficient locations, and those manufacturers start to ramp up production, you're going to find growth being a lot easier than when you're at peak manufacture. Like, you got all this stuff you manufacture but nobody wants it. You got all this inventory built up that nobody really wants. How are you supposed to get the inflation growth coming from that when you have an ample supply of crap out there? Right? They needed to clear out all that dead inventory and shut down the less production that was happening in order to reestablish manufacturing in the more efficient areas and then get the growth to come back again. I mean, that's kind of an overly simplified way of saying it, but I mean, it's not even that simple to really think about. Anyhow, how far are we into this? 10 minutes. Okay. Was there anything else I wanted? Oh, okay. Unemployment. This is the other thing. Okay, so jobless claims have dropped dramatically. Like, people are not claiming the unemployment like you would think would be taking place going into a recession. Like, going into a recession, you think unemployment would be rising, there would be more jobless claims going on out there, but that's actually the opposite of what has taken place. So as long as people have money, then you're going to find that the inflation coming down is going to be difficult, right? And although a lot of people will dispute the Phillips curve, the Fed looks at the Phillips curve, which is basically more people working, more money coming into the system, more people are then doing transactions, which then increases money velocity, and then in turn is like as if you were creating inflation with it, right? The more money, or the more a dollar changes hands, the more that we start chasing those goods and services out there, the more demand for money that comes up from it. So when you have a lot of people who are working and there's low unemployment taking place, then that's a signal to the Federal Reserve that the interest rates need to be remained elevated, right? Once people start losing their jobs and they stop participating in the economy and stop making those purchases and they start holding back on things and saving more, that's when the Federal Reserve will be like, okay, here's our cue, right? That once this has happened enough, then the interest rates can come down to start stimulating the economy again. But until that happens, until you actually see unemployment come down and you start feeling the pain in the economy to start clearing out some of that dead undergrowth, which basically means a lot of bankruptcies and, people going, having to start over. I mean, what else can you say? That's where the growth will start to come in, and then you'll find that, a lot more potential can come out of it because it won't be being consumed by zombie corporations and zombie people out there. Right on. Okay, I'm going to start reading, if I can, man. I forgot my glasses. Do I have my glasses on here? I don't. Okay, well, let's see if I can read any of this. I see All-Nighter in the house. Good to see you, brother. All right, great content. Thank you. Howdy, folks. Howdy, Mr. UE. Well, howdy yourself. I need a loan for a houseboat. That would be nice. Hit the like, ladies and gents. Yes, please do. Lumber. Yeah, lumber is down dramatically, isn't it? We're at $480 per thousand now. I think a lot of that has to do with the home builder sentiment turning negative, which is, I know for like a lot of people, this is like a sign that, to me, when I look at this, when I think about the lumber coming down in price, already there was a lot of mill curtailment taking place. And when these prices come down like they are, that's going to exacerbate the problem of the mill curtailments. There's already a tight inventory out there, but because the demand comes from the home builders and the home builder sentiment is down, the demand for lumber is down, but the inventory is tight. Right? This is a situation that is just like, it's only building more tension. Right? And so at $480 per thousand, really, we have to consider this for just a moment. How much time do I have? Okay, I'm going to try and keep this short. At $480 per thousand, really consider this for a second, right? It's recently changed, the contract size and the way that it is being delivered. So prior to about 4 or 5 months ago, I guess, prior to that, contracts were 110,000 board feet delivered to a central location up in the British Columbia area. It was this like central hub. It was a handful of these mills who would provide, delivery to this one spot, right? That's what the contracts were for, 110,000 board feet, which was one rail car. Now, you have to think, there is mills and lumber and stuff all over the country, all over Canada, right? And each one of these mills will sell at a different price, right? They have their cash price. but it's somewhat similar or fairly close to what the futures contract price is, but it's not exact. Like the futures contract doesn't mean that's what the mill is going to be selling it for, especially if you're purchasing something from them today, right? So each mill has their own cash price. There is another way of looking at the futures price, or at least at lumber prices, that is not necessarily the futures price, it's at the cash price. um, you can find some of those numbers out there at bar charts has cash price at it. But really, when looking at the futures price, it has what I believe a much better look at what the builder sentiment is going to be, because those are the people who are getting ready for the activity that is coming in the future. Like they are looking at what home builders, what the lumber yards are going to be buying, what the distribution network is going to be getting into. They're looking at the futures price. The cash price is what's actually occurring today, what they are paying for it. Now, when you look at the futures price and you look at retail, there's a big gap happening between them. Like at 480 per thousand, you should see 2x4s a lot cheaper than what they are selling for at the retail end. But because of the lack of inventory out there, right, or a diminishing inventory, you're finding that the retail price is going to remain somewhat elevated until that inventory level begins to rise, even though the futures price is coming down. You see, because the cash price at the mill is much higher than what the futures are believing that sentiment is going to be. Very confusing stuff. All right. Point being, right now, with the home builder sentiment about, well, I mean, it's turning negative. I mean, it's slightly above negative what is it, at 51 on the buyer traffic, or not the buyer traffic, but sales condition, I think is still slightly positive, but that's going to turn negative here real soon. And then once that has taken place, the demand for lumber in the futures market is going to be very low. But the cash price might end up being quite elevated if the inventory stays low. So we're going to have to see how that plays out here going into the future, into the next few months. But again, like in my opinion, the situation that we're in right now, I just don't see how lumber could really dramatically get any cheaper than what it is. You might find where retail comes down a little bit more, but even at the, you know, I'm selling 2x4 8 standing and better at what, $470 per $4.70 for an 8-footer, right? So 470 there. Lumber had peaked out. We were selling them at the all-time high of $13.50. So we're dramatically under the all-time high, but still 470 is a high number. I mean, it's not something that. Put it this way: we were selling lumber about that price back in 2018. Right towards the end of 2017, going into 2018, we were selling 2x4s for about the same price we are today. So this is pre-pandemic pricing right now. And in my opinion, I think that's a fairly decent price. Could it go lower? Sure. But if you're in need of lumber right now, with the tight inventory that's happening out there, I just don't see where really you're going to get much better of a deal than what you're going to get provided with today. And even just recently, like we had a plywood issue where we couldn't get our plywood delivery for a few days. And now when you're ordering an entire truckload of plywood, that might be the case. But if you're ordering a single unit, you're going to the distributors out there who would typically have units on hand that they can send to you. You get deliveries twice a week, so they can put that unit on the truck and deliver to you. But if they're out of stock and nobody has it, that's telling me that there's shortages starting to happen, or at least a depletion of the market. Is it significant like we had experienced? Not even close, right? But it is, a sign. It's concerning. Anyway, that's the lumber update. So, calling 9 on the die. I need 30 for a small houseboat. I'll pay 10% interest. Hey, Simon, what is plywood at these days? So like CDX, half-inch CDX, I think we have it at like $27 a sheet. And, prior to the pandemic, 24, I think, was the high. So this is pretty elevated. It's even higher than pre-pandemic, but we had peaked out, and during the highs of the pandemic, it peaked out at 80 something dollars a sheet. So at 27, yeah, it's dramatically cheaper. All right. I'm going to give it 10 more minutes here, guys. Deflation is a natural phenomenon. Yeah. And when you have the situation that's occurring now, see, this is really where I became a strong dollar theorist, is that it was a lot of stuff that was happening within this speech that I saw occur. Like he talked about it in the speech, and then things started happening that really started telling me that, man, I'm not trying to say that it was planned, because so many people say that it was planned, pandemic, all this other crap. I'm not taking that kind of thought. What I'm saying is that after reading this speech and seeing some of the things that were occurring, a lot of stuff that was happening got fixed. Like one of the issues that was happening prior, that's mentioned in the speech, is that the spread between safe um, safe assets, like the U.S. Treasuries, was too low comparatively. Like the gap between the corporate debt, the risk of the corporate debt, and the safe return of U.S. Treasuries, that gap was too wide, right? This is one of the things that they had mentioned in there. During the pandemic, when they dropped interest rates to zero, we saw Treasury yields go. In fact, some of the short-term Treasury went negative for a very short time, but most of it went down to very low, to very close to zero, right? So during that time, corporate debt was really the only place that people could go to get any kind of return on their investment, any kind of fixed return. Right? So the safe and steady return of a U.S. Treasury just wasn't in the cards for these guys who were looking for that return of yield coming from the corporate debt, or at least that's what they found in it. People started diving into the corporate debt, and then they exasperated that problem with the special purpose vehicle of being able to lend money to these corporations, right, by buying their bonds. They called it the corporate debt lending facility. They didn't really buy a whole lot of the corporate debt. They just said that they were going to, funded it with hundreds of billions of dollars, bought a little bit, but that credible threat alone was enough to get people to dive into corporate debt, believing that they were front running the Federal Reserve. So what that did is it started driving the yields down on that corporate debt and drove them ever closer to the returns that the U.S. Treasuries were yielding. Right? So all of a sudden, this issue of having too wide of a gap between the corporate debt and the U.S. Treasuries all of a sudden disappeared. Right? All of a sudden, we had corporate debt yielding just about as close to the U.S. Treasuries, and then it fixed a lot of the issues as far as like people looking for that money going into the safe returns of the U.S. Treasuries and not lending money to the corporations, driving the corporate debt yield ever increasingly further away from the U.S. Treasuries. Well, after the pandemic, people were more than happy to allow the corporations to gorge on incredibly cheap debt. It was like as if they stimulated the corporations without actually having to do anything, right? All they had to do was say they were going to do it, and the people did it for them. It was kind of crazy. Yeah. All right, 8 more minutes here, guys. Peace and blessings to you, brother. You've helped me understand the economy so much. I always check your videos to see the real current status of the economy. God keep you and your family. Well, thank you so much, man. I really appreciate that, John. I mean, I come out here and I talk about it because, I'm trying to learn. Like, I try to learn as much as I can and then share the things that I learned with you. And then we talk about that. I mean, everybody's going to have a different perspective on things. Some people are going to be really focused in on maybe their business. They have a business, and they're looking at the economy to make sure that they're conducting themselves in their business appropriately. They're not going to look at things the same way that somebody who's looking to maybe go to school or something like that to figure out what it is that they need to learn or the skills that they need to take on in order to deal with an economy coming into the future. These people aren't doing the same thing with the economy. They're completely different. People who invest, I mean, just because you look at the economy doesn't necessarily make you an investor, right? And just like, somebody's going to learn a skill to figure out what it is that they need to do for themselves in this world, as opposed to somebody who's just trying to figure out how they maintain themselves in this world, as opposed to somebody who's trying to invest into this world. These are all different thoughts. And then even as an investor, if you're 18 years old getting started, you're going to do things so much differently than if you're 80 years old trying to maintain your wealth. These two types of investments are not even the same thing. Like they don't even remotely look like the same thing. But all of us look at the economy right? We're all looking at these numbers. We're all talking about the events. We're all talking about where the Fed funds rates are going to go to and stuff like that. And we need to take this information in for ourselves and then decide what it is that we need to do with that, because every single one of us is our own economy, right? I mean, we own our own economy. It's not somebody else who, like, I always kind of laugh when somebody says, how do you fix the economy? And I'm like, fix it? What do you need fixing? You need to fix what it is that you're doing inside of the economy, not fix the economy itself. That's like, there's no fixing the economy. The economy just is. It's just a thing, right? And we all have to participate within the economy in our own fashion. And that's what studying this stuff does. Like, if you look at all this information, you just constantly take it in. You take in Gresham's law and Cantillon effect and Triffin's dilemma and the bullwhip effect, and you really try to, relate these things to your everyday life. You can see the economy playing out every single day. Even my buddy who was telling me about, my builder friend who said he's getting out, him talking about the labor costs being so expensive in our area here, right? He says, man, I could go to where, back home where I'm, where I live, he builds down in here. He builds all over, but, he has his like home base area, which isn't too far from here. He says the labor costs in back home are half of what it is here, right? He says it just doesn't make any sense. And I said, well, it does make sense when you think about who has moved here. Like, this used to be a working class town, but it's not anymore. It's more like retirement, right? We have this huge hospital district that's growing. We got retired folks who are moving here and finding, like, a clean, beautiful, low crime, I mean, it's like the place that you would want to retire. And we have like a lot of remote workers, who have moved here because, this is a nice area to be in. So the real estate has gotten very, very expensive. And there's not a lot of working class jobs out here that are going to be able to sustain a standard of living in our area now, because it's grown so expensive. Like, the wants and the needs and the desires of the people who have moved here have elevated the standard of living. It makes it very difficult to have a working class job here, right? So now the labor costs that are now incorporated into living here have elevated, and people say, man, you're so expensive. Why is the labor so expensive? Right? It's because it costs so damn much to live here. So they start bringing in labor from outside of the area, right? So if you think about the Cantillon effect, when the people had dove into luxuries, right, elevated the price of everything because they're diving into luxuries, and then all of a sudden, the people who were there, who were producers, had to leave because the elevated standard of living that's down, occurred. So they can't afford to live there anymore. They leave, and then what happens? Foreign production starts to come in, and that's around my area. So understanding like the Cantillon effect and understanding like the increase and decrease of money to a state and how the dive into luxuries drives out the working class of people. It's obvious. You can see it happening in Portland. You see it happening here in Astoria, and you can read about it in Cantillon's essay from the 1700s, right? I mean, it's something that is an economic force that is always going to occur, and like, there is no fixing this. It's just understanding what is happening so that you can position yourself in the best appropriate spot you can. All right, what we got? I'm gonna give it 2 more minutes, guys. All right, Dishes, thank you so much for hitting that heart. We're bringing up the heart. All right, nice timing. Loving the ear can. Here right on. Hey, scratch my ass. Good to see you. I woke up completely confused. All right. Not gonna lie, I tried farming in the yard and the harvest was pathetic. The dollar needs to maintain its value or I'm gonna starve. Well, you think about it, right now, the dollar is doing far better than what anybody had ever anticipated it was going to do. It's at 105 it's 105 on the index, on the US dollar index. Take a look at that index. Like, go and just, you can punch it up and look at it for the last 5 years. There was a short time just a few years ago where it was higher than it is today, but it is stronger now than it was, for the last 5 years, even 10 years. I mean, I think you can go back I don't know how far back the chart needs to go before you find it that it was more elevated than it is today. But you're going to find that the dollar is far stronger than the narrative, right? The narrative says that it's weak and, dollar destruction and hyperinflation and money printer go burr, but that's not the case, right? The dollar is strong around the world. The dollar is very much desired, right? Even though how much you hear about the BRICS nations, if you were to go into any one of those BRICS nations and you wave a $100 bill around, there is not one person out there who wouldn't take it. Not one, right? They would all take the dollar. Every one of them will, right? And really, when you think about this, it's the liquidity of the dollar that they want. They don't even care, right? They don't care what it is. They just want to be able to do transactions. That's the important part about it. And when you have a liquidity issue where all of a sudden the dollars are starting to shrink, the pool of them out there, and you think the Federal Reserve right now is in quantitative tightening, that pool of dollars is shrinking. The liquidity issues are starting to manifest themselves around the world, and they're freaking out about it. They don't have enough dollars. Right? So they're doing transactions in whatever currencies they can. They're not trying to get out of the dollar because they hate the dollar, or they think that, the dollar is some kind of worthless item. They're getting out of the dollars because they can't get them. They can't find them. Look at Argentina, right? They're talking about it right now. How they're, like even Whirlpool is setting up trade in yuan. And if you dig deep enough into these articles and get away from the opinion that they're getting out of the dollar because they hate the dollar, you're going to find that they're getting out of the dollar because they can't find them. They don't have enough of them to do the transactions. And so they're starting to do transactions in whatever currency they can. And that's really what it comes down to. This is the preliminary to a liquidity crisis that is manifesting itself right now. And if the Federal Reserve continues with their quantitative tightening and elevated interest rates, which I believe they do, or are going to, we are going to find going into in the future here that there's going to be very obvious signs that liquidity issues are taking place. I believe that the Treasury right now is taking out so much debt and loading up the Treasury general account with cash, getting ready to deal with a liquidity issue that would happen within the bond market. And the moment that a bond comes up for sale, that there is no buyer for it, the Treasury will be there. The Treasury will say, no, that market is going to stay liquid, and they will act in a quantitative easing fashion. The Fed won't need to purchase the bonds. The Treasury will buy them back, and they will provide the liquidity for that bond market. The rest of the markets, who knows, right? I don't know who's going to provide the liquidity for that stuff. But when it comes to the U.S. Treasuries, I believe that the U.S. Treasury itself will maintain the liquidity within that market. All right, I got to go back to work. That was a lot of fun, guys. Thank you very much for hanging out. We had 187 of you with 66 likes. Thank you very much for hitting that like button. And what else do I got? Links are down in the description. Uneducated Economist, you let me know. Oh, that's the other thing. I'll throw that out there one more time. For those of you who still have the chance to do it, I'm going to go to Vegas next week. We're coming, it's coming up very quickly for the Stock Pulse Silver Symposium. I will grab a link to that and I'll put it down in the description of this video once it gets uploaded. All right, Uneducated Economist, y'all have a great day. And you let me know.